It's Scott Garlis at Stansberry Research. I'm here at the 2019 Alliance Conference in Las Vegas. I'm here with Rez Kalir, co-founder and CEO of Stansberry Asset Management.
Good to see you, Scott.
Rez, thanks for being here.
Thanks for having me.
Certainly. A great couple of presentations the last couple of days.
Thank you.
Certainly, and I would like to ask you a few questions. The first, you spoke about opportunity zones and the tax benefits they provide. Do you find that investors ignore the tax implications in their investments?
I think it varies a lot from investor to investor. I think if you look at some of the best investors in the world, folks like Warren Buffett or John Malone, there are other examples. Some of those folks are extremely tax conscious of everything they do. Other folks are less so. So I think there's just a lot of variation.
And then how important is tax planning for an investor?
Well, I think it's not everything, but it's an important part, I think, of making investing work. I think that folks who are patriotic and who like to play by the rules, which I hope describes most of the world, should want to pay their taxes in full. But the fact that you would want to sort of pay your taxes and be a good contributor to society doesn't mean that you would want to pay more taxes than you have to. And so if the government creates ways, and the opportunity zone legislation is a good example of that, to lighten up your tax burden in a way that still hopefully benefits kind of society, which is the whole idea behind the opportunity zone plan. The idea was to try and create an incentive for capital to move into some of these low-income neighborhoods by using the tax code to create that incentive. I think that that's something that investors should want to be thoughtful about.
100%. And then can you discuss a little more about what you look for at the property level in these opportunity zone investments?
For us, I think the most important thing we try and do in assessing an opportunity zone project is investing along what we call the path of progress. So we like to have a really granular understanding of the city and the neighborhoods that we're investing in. You can go to some of the cities where we're active in places like Charlotte or Charleston, and it's almost like you can close your eyes and you can imagine or see what the city is going to look like 3, 5, and 10 years forward, because it's already been zoned in a certain direction. There already have been meaningful investment dollars used to develop it in a certain direction. And if we can piggyback on that, if we can sort of find a niche where we have an opportunity to invest along that path where we have a great deal of confidence that the city is going to expand and develop in a certain direction, that creates a catalyst for our investment that is attractive, and that's what we look for.
And then you spoke about asset allocation as well. What's the biggest mistake you see investors making in this topic?
I think one of the most thoughtful folks that I've listened to and read on the topic, maybe the most thoughtful person I've read on the topic, is Ray Dalio, who's the head of Bridgewater and the founder of Bridgewater. I think the simple but very powerful observation that Dalio makes about asset allocation is that asset classes have a seasonality to them, and that an asset class that performs fantastically well during one decade may perform in a mediocre way or terribly in another decade. And so I think what Bridgewater does is they're very kind of thoughtful in analyzing the value and relative value of different asset classes on a decade by decade, if not more frequent, on a year by year basis. So they're constantly putting every kind of available asset class next to the others and saying, let's try and get a sense of the risk reward in this particular asset class and make a judgment about allocating assets dynamically. I think a lot of people approach asset allocation in a much more static or one-off way. Like they ask themselves, how old am I? Okay, I'm this old. I'm 50 years old, or I'm 60 years old. And on the basis of my age, I'm just gonna decide I want this much in stocks and this much in bonds and this much in gold. And I think the Bridgewater way of doing it, where you're doing that on a regular basis, not just once, but at least sort of once a year. And you're not doing that on the basis of how old you are, although that may be one variable that goes in. You're actually doing that by comparing the risk-reward potential embedded in those asset classes to all of the others. Is a much better way of doing it, but I don't think that that's the way most everyday kind of our ordinary investors go about it.
I think that's very fair. Powerful stuff.
Thank you so much.
Thanks for your time.
Thank you.
Thanks for watching, and stay tuned for more updates.